Welcome to the podcast.
All right. Thanks, Ryan.
Yeah.
Love being here.
Yeah, thank you for coming. I really appreciate it.
Of course, man.
So the first question, Phil, is how did you land in life settlements? I have personally never heard of this industry.
Yep. You're not alone.
Tell us how you landed in this industry.
Yeah. So we're going on just about probably 20 years ago now. It was like 2004, I believe. And a friend of mine was in the industry. And he was working within the life settlement space. And he had one of his companies was actively purchasing life insurance policies. So he asked me, I was in commercial banking at the time, actually it was Comerica Bank at the time. Mm-hmm. And he asked me to come and be managing director of that company that was buying the life insurance policies in the life settlement market. And keep in mind, this was very early when the industry was really just picking up steam and getting going. So I came in, learned the industry, did that for a couple years. And I told him, I said, you know what? I want to start off and try to do the brokering side of policies. In other words, representing policy sellers, working with the advisors and helping the sellers sell their life insurance policies. So instead of being on the buying side of these companies that are purchasing the policies, I went over to the side of selling, helping people sell their existing life insurance policies. Started my company then, and that's what I've been doing for the company's now 18 years old.
So are you telling me that this is a relatively new industry?
It doesn't feel new to me. I feel like I've been in it forever. I've been in it 20 years. But yeah, in a lot of ways, it's still in its infancy. Because when I jumped in it then, and then candidly in 2008, I mean, we had the financial crisis. The industry had its own issues, and there were a lot of challenges. But right around 2010 or so is when a lot of regulations started coming out state by state by the Department of Insurances. Mm-hmm. So if you think about that, I mean, it was really more or less just an unregulated industry prior to that for the most part. Mm-hmm. So yes, in a lot of ways, it's still a relatively new industry and new to a lot of people. So this, when you learned about it from me and when I talk to other people and they learn about it, most people, the general consumers, have no idea about it. And in fact, even in the advisory world, very few people, I tell them, I'm the first person still to tell them that this industry even exists. The fact that people can sell their existing life insurance policy.
Yeah, and I have life insurance. I never thought of it necessarily as an asset that someone else would want.
Yep.
So if you can now, Phil, please define what is a life settlement.
Yeah, so the definition is a life settlement is the sale of an existing life insurance policy for an amount in excess of any cash value. So we're not giving it back to the insurance company. There's third parties that are purchasing that life insurance policy, and they will become the owner and beneficiary of that policy. And believe it or not, since a Supreme Court ruling in 1911 called Grigsby versus Russell, it established that life insurance is actually property that can be sold. There was no industry that was created around it back then. Nothing took off. There was nothing, but there was a specific case in which the policy was transferred and sold, and because of that, it was determined that life insurance is actually a property. So you can actually sell your life insurance policy, just like you could sell a house or a car, you can sell a life insurance policy. It's an asset. Now, that being said, it's not like everybody doesn't qualify. And most people we deal with are seniors, 65 plus years old.
Got it. And so I recently had a circumstance with one of my clients where they mentioned to me they were exiting their life insurance policies and they were going to do so by just letting them lapse. Right. And what I understood at that point is that knowing you early on, right? So before they get to a critical point in the life of that policy is very important.
Yes.
And so if you can really dive into the details, the scenarios that are appropriate for someone to consider a life settlement.
Yeah, exactly. And in that situation, it's exactly when to mention it. It's when people oftentimes are just reconsidering, is this life insurance even serve its purpose anymore? Do we need it? The most common reason that we see it is when people see a premium increase, when they all of a sudden see, they get a letter from their insurance company that all of a sudden the cost is going to jump.
And why would that jump? Because again, treat us like we don't know anything.
Yeah, I got you.
I have life insurance. I don't know about it still.
Right.
I just have it.
Right. You just have it. Right. Exactly. So there's different reasons. So probably the most common that we all know about life insurance is like a term life policy. Term life is a set premium level for a period of time, 10, 20, 30 years. After that period, most people just plan on getting rid of that policy. But if they don't and they keep it, it actually jumps into a very expensive period called the annual renewable term period. And you will know because those premiums will get way more expensive in that. Now, with that being said, at the end of term periods, if they still have a conversion privilege in place, the policy might be able to be converted, and that's another option available to them that actually makes a life settlement more possible at that time. However, so term policies, you have a level period, you're paying it, you're comfortable, and all of a sudden it's going to jump, or you got to make a change, or maybe you just get a new life insurance policy, right? Now, other reasons, if people have like a universal life policy, which are whole life with flexibility, think about it that way. You have flexibility, and maybe some people know this. It's like you start off the policy and you have a set premium, and they're cash value policies, right? The cash can grow over time. However, internally, a lot of these policies have a clause called the cost of insurance. And that cost of insurance is increasing each year. So it's almost like you have this, think about a cash value account, and then it's being debited every month, something out of it. So you're putting money in, you're hoping it's growing at a certain rate, but there's a debit. As it goes off along in time, and especially as we get older, that curve for the cost could almost get exponential. So all of a sudden, it's pulling more and more and more money out, and all of a sudden, you might see your cash value dwindling in these universal life policies if the investment isn't outpacing the cash value. Does that make sense? You follow me?
Yes.
So if your investment, like you're investing, but there's this cash pulling out, and the cash gets more expensive, and all of a sudden you're like, wait a second, I've been paying on my $1 million policy, I've been paying $10,000 a year. It was supposed to be fine. Then all of a sudden, I got this notice that I'm almost out of cash value, and we got to put in $20,000, and I'm 70 years old, or we're in trouble. That is the type of scenario that pops up, and they're like, I didn't expect this. So again, it's not that they're bad products. It's just understanding what you're in and where you're headed. It's very important to work with your advisor and understand the type of policy. But that's another example when, it just pops up and it's getting more expensive and people don't know what hit them. And so we get calls like situations like that. Hey, I'm not sure I want this thing anymore. I don't know if I want this policy. It's going up and it says it's going to go up next year too. So those are, some examples.
And what about just straight whole life?
Yeah, so straight whole life, which we call traditional whole life, those premiums are rigid, so they're more of a set premium stream. So in some ways, they're more secure in that you know what you're getting. It's kind of set, and a lot of these companies pay out dividends, and they could be good long-term planning tools. It's more of a straight. We do see those. We see traditional whole life policies that people are trying to sell sometimes regularly. They're a little harder to sell in our life settlement market because the premiums are rigid. And the investors that purchase the policies, they like the flexibility of a universal life policy where they can pay less or the minimum every year. As a buyer, if you're buying something, you want to pay as little as possible each year. Same idea for the life settlement investors. They want to buy, they want to spend as little each year. So the universal life policy allows that flexibility. Whole life, more rigid premium streams, harder to do, but not completely impossible. You could still do it sometimes.
So at what age should someone consider or possibly have their policies reviewed?
Yeah, well, review you probably should do regularly with an advisor. So reviewed, you should know what you have, see what because you don't want to be surprised. You don't want to be surprised. But for considering a life settlement, we say typically 65 plus years old. And if you have a policy, it doesn't have to be a huge policy. It could just be $100,000 in death benefit or greater. It might have a chance for a life settlement, and it's worth considering. That being said, there's exceptions to the rule. It depends on the type of policy it is. Is it a term policy with a conversion? If it's convertible, the probability of doing something goes up. Maybe you could do it. If it's no longer convertible, like I was talking about earlier, you can't convert it to a universal life or whole life policy, then it's going to be more difficult to do, depending on health. And candidly, in our industry, it's the opposite of getting new life insurance. The more health issues you have, the higher the probability of selling your life insurance policy because the buyers in this policy are working off life expectancy. And so, depending on the health, if you have significant health issue and you're in your 60s, you might have a chance to do it. It just all depends. And so, we'd like to say, it's not necessarily a hard set rule, and there's so many different policies and different types of policies and nuances that it really takes a lot of detailed analysis to determine which ones are going to work and which ones aren't. But like I said, some general rules are universal life policies are probably the most attractive in the industry because they have flexibility. Term policies that can be converted to universal life policies are also probably the most attractive. And then whole life or variable universal life, those could be considered as well. There's not a hard and set rule, but in general, a senior, 65, 70 plus years old, has a policy they're not sure they want or need. that is the situation in which a life settlement might help them.
Got it. And like most people, I bought term life insurance to protect my family.
Right.
I personally bought whole life when I was a banker to build the cash value. But what I'm hearing you say is people should really be aware of what type of policy they have so that they know if perhaps it would be eligible or more appetizing for a buyer in the future.
Yeah, exactly. I mean, it's one more option, right? To know that, hey, that might be an option in the future as well. So I don't know what your policy is, but let's say once you approach age 65 or 70, if it's going to be a term policy that long, you want to double check that policy and say, when is that term conversion expiration date? When is that coming up? Sometimes it could only be the first 5 or 10 years of the policy and it's over. Sometimes it could say up to age 65 or age 70 or age 75, you can convert this policy. It's just important to know, not just for a life settlement, but it's important to know for yourself, because what if something happened, God forbid, but you all of a sudden have a significant health issue, cancer, something else. You don't want to be stuck with that I tell you, there's two, I know it gets a little confusing, but there's different options here. The level term period, and then it ends. And then if you don't have a conversion privilege, it usually has the option for you to keep that policy, but it gets super expensive in what's called the annual renewable term period, and it jumps every single year a lot. And so you want to know when that conversion period is, because maybe you could convert it to a universal life or whole life policy and not be as expensive, still have the coverage, maybe still have a good cash value product you could grow, and you have a chance to still have that coverage. Because if some significant health issue comes up, right, it's going to be hard to get another policy. You're probably not going to get approved for a new life insurance policy. So you want to know that term conversion expiration date. And then as far as, the other policies, whatever advisor, whoever you're working with, just double check, ask for an illustration, illustrate out the next 10, 20, 30 years, see what it looks like, see how the cash value grows. Again, if you have a traditional whole life policy, you're probably relatively safe with a good cash value growth over time.
Got it. Share with us some examples of how you help your clients sell their life insurance policies.
Yeah, sure. And like I said, most people, come to us in situations where they decide they don't need it, the premiums are getting too expensive. I'll give a couple. One, because I know, actually with regard to, I know you deal with a lot of business owners. What happens sometimes is with businesses, right, they get life insurance policies on their key man. They go key man policy, a business-owned life insurance policy. And they have an older executive and they're not sure they need the coverage anymore. And, that can be an opportunity to look at it and say, hey, wait, before you just let this policy go, if you're not going to keep it yourself, let's see if we can get some cash back for it, So, for instance, there was one particular situation. It was actually a client, and they actually owned a furniture business. And the policy was $1.5 million universal life policy. And it had just under like $100,000 in cash value in it. So if they didn't need it, they're just going to take the $100,000 in cash value. But they came to us with it. We do an evaluation, and what we do is we, of course, have our disclosures, forms signed, et cetera. Then we collect life insurance policy information and medical information from the doctors. And we do that at our cost. And
so you do that?
We do that.
So as a part of your process, when you take on a client, just like an underwriter in a loan scenario, you're underwriting the opportunity, right?
Exactly. So we do that, and we do as much as the client or the advisor wants us to do. If it's an advisor who's already wrote the life insurance policy and they're the agent of record, they might be able to get the life insurance policy quicker. We work together with them, and they provide that to us. But we can with our authorization if that's what they want. And then with a list of doctors, we also request the medical records. So we collect that information, and then we do initial analysis ourselves, because we're not trying to waste anybody's time, because it's not as easy as I kind of alluded to earlier. Just because you're 65 plus with a policy doesn't mean you get to sell it right away. If it was that easy, it'd be great, but it's not. It has to fit a box, and the investors have their different parameters. So we evaluate that information to determine if it's feasible, if it's going to make sense, is it going to meet the client's objective. In this situation, we did that, and then we go out to our network of buyers, and we have 30 plus buyers across the country. And the name of these buyers, designated by the Department of Insurance, they're called life settlement providers. That's the licensing, state by state, that these buyers have to have in order to purchase a life settlement policy. So we go to these buyers then, and we create an auction-like atmosphere to create the best offer for the client. So In this particular situation, $1.5 million policy, they weren't going to keep it. They were going to surrender it from the life insurance company and take $100,000. And we helped them sell it, and they received $425,000 for that $1.5 million life insurance policy.
Is that taxable?
So it's the tax code goes like this. So depending on the basis is going to be the premiums paid into it. Candidly, I cannot recall that exact scenario, but it's capital gains. The basis is the premiums paid into it, and everything above and beyond can be taxable. In that situation, it may have been, they had the policy, I think, for 20 years. Maybe not. They've paid a lot. It was a universal life, so it wasn't a cheap term policy. They may have paid, I don't know, close to that much at that point in time. But the way it works is everything the basis. However, if the basis is below the cash value, then the cash value, from the basis to the cash value, it would be ordinary income. And then from the cash value to the life settlement value, the sales price, that would be capital gains. But oftentimes, truly, they usually paid more than the cash value into it, so that's almost irrelevant. And candidly, depending on the situation, they've paid more than the life settlement value, so there's almost no taxable consequence. Of course, we always talk to your CPA, et cetera, but I'd be happy to share, the code and everything else with people to understand that better.
Got it. What are some of the things people have to look out for when selling their life insurance policy? For example, in my industry, what I say is I mitigate the risks of a loan, whether it be a business acquisition, a franchise startup, or a real estate purchase, before we even get to the closing table. In your industry, when people are looking to sell their policies, what are some of the things they have to look out for, possibly being taken advantage of? And then how do you bridge that gap, being an expert in the industry?
Yeah, it's a good question nowadays, and it's relevant. One of the things about being such a relatively unknown industry is that people can get taken advantage of. I always tell people, it's not like real estate where, hey, the home next door sold for $1 million, mine's probably worth $1 million as well. People usually have no idea what their life insurance policy is worth in the life settlement market. They have no idea.
Right.
So it's important to know who you're working with. There's companies out there, and they're not bad companies. It's just a lot of them are buyers, and we work with these buyers, and they do a great job of advertising, et cetera. But they're buyers, and at the end of the day, a buyer's motivation oftentimes is to get something as cheap as possible. Just like if we were buying a car or a house, we want to negotiate for ourselves and get something as cheap as possible.
Yep.
So sometimes, without creating competition, awareness, or some type of analysis up front, not knowing what you have. Yeah, you can be surprised about what the real market value of the policy is in the life settlement market versus what you got if you're not careful. Let me give one example. There was a situation, and the policy was a $700,000 life insurance policy, and it started off. It was on a male, 78 years old, and the value of the initial offer on that policy, they were going direct to a buyer. The initial value they offered was right around $70,000 for the policy.
That's what the buyer offered them.
That's what the buyer offered directly. Then they came to us kind of for a second opinion. So then we provide seller representation. So we're representing the seller to push it, right? We go to our different sources, et cetera. We push up the value, and this client ended up getting over $300,000 for that policy versus the $75,000 that they would have been, and they thought that was a good offer to start.
They would have been happy with that.
They would have been happy with that.
But they didn't know what they didn't know.
Exactly. They didn't know. And that disparity, it is not uncommon in the industry. And part of the reason why, it's not even that the buyer's trying to necessarily take advantage of them all the time. It's that the underwriting's different buyer to buyer. If they're based on life expectancy is a big driver. So if someone's working off a 6-year life expectancy, but this other buyer is working off a 12-year life expectancy, the 12-year life expectancy offer is going to be a lot less than that one working off the 6-year life expectancy, and they don't know. So unless you're really covering your ground, covering all the options, and helping them push up that value with some type of representation, that's what we provide, the representation to the seller, then you just could be lost in the shuffle and end up disappointed.
Yeah, I mean, we don't even know necessarily what we have in terms of the policy itself.
Right.
How are we going to know what we have when we put it on the market to be bought? If we even know that, right?
Yeah, exactly. And it's a little bit of a moving target too, because there's different buyers coming in and out of the market. as it is. The life settlement providers are the licensed entities, and they're raising money from large funds and institutions to pension funds, et cetera, to purchase these policies. So sometimes they come up with a different methodology on the back end, and maybe it's more aggressive. Maybe these guys are buying more aggressive right now, and you got to know that to be able to get them to give the best offer to your client.
Yeah. So
if you don't know that, and you're going to this guy over here that just you just go to one buyer. I mean, why would you go to one buyer anyways? Just like with your house, typically you have an agent that's going to be like, well, I'm going to try to find the best buyer, and I'm going to get 5 offers in here, and then we're going to pick the best one, right? Same idea. Same idea of what we do.
Yeah. So when are there instances when someone allows their policy to go on too long? And you know what? Hey, if you would have talked to me last year, I would have been able to help you. But these things happened, these triggers happened, and now guess what? Your policy doesn't have value. What are some of those things that you can really be specific and clear on?
Yeah. The most common is kind of what I alluded to earlier, is the term conversion date. Okay. So a lot of the people come after, they let the conversion date expire, and they say, hey, can I sell it now? And it's like, man, if you would have came to me a year ago, at least we could have looked at it.
What is that specifically for people that don't necessarily know what that means?
Yeah. So the term conversion allows people to convert their life insurance policy. Okay. It's for a term policy. These are for term policies, okay? So level term, the most common, cheapest life insurance. And if they can convert it it allows them to convert it to a universal life or whole life policy. Okay. And so you let that expiration date pass, and then you're in that annual renewable term period.
So before, if you're proactive, how do you convert it to your advantage? Explain that.
Yeah. So what you do is, like, say at least 3 months before that conversion, we start evaluating the policy. We get an illustration assuming it's going to be converted, and then we start doing an analysis to see if it's going to be valuable, see if it's going to have value in the life settlement market. And if so, if the person says, I don't really want this policy, or I don't really need it any longer, well, then we could look at it and maybe get some type of value for you out of that policy, some kind of cash life settlement for you out of that policy. But once it passes that conversion expiration date, and it's in that more expensive period, it's really hard to do unless you have very significant health issues. So the more significant the health, there's a higher probability. So if you have very significant health issues, there might be a possibility. We have settled policies in the annual renewable term period, but it requires more significant health issues. And then it's just, again, especially if you're a senior, say 65 plus years old, it's worth just considering, once that expiration date, if you don't want the policy, just consider, let's take a look and see if I can get something out of it before I just let it go, or before it gets really expensive. Let me see what it looks like, I mean, the other, time when if you have like a whole life or just universal life type policy, is if you're allowing it to go into grace period because the premiums are getting expensive, and you're just letting it go, and it's putting strain on you, and you haven't considered any options of either maybe decreasing you could decrease sometimes the death benefit. That would be maybe a cheaper option for you. But once it's in the grace period, it gets hard, because then you're like, okay, we got to look at it, we got to evaluate it. You're gonna have to pay a lot more premium probably to bring it current again for us to be able to. Sometimes insurance companies can be difficult when you're collecting information if it's in the grace period. Sometimes we can't get an in-force illustration once it's in a grace period. An illustration is a projection of the values, a projection of what it looks like over time. We can't get that illustration sometimes. So it's not impossible. You're in grace period. We look at it at a time, but grace period from an advisor standpoint is a good sign to reach out to your client and say, hey, it's in grace period. What's going on? Do you really want this policy no longer? Do you need it? Where are we at? Because, well, you know what? If you're thinking about letting it go, let's see if a life settlement could help you. That's a trigger to say, let's take a look at it if it's hitting grace period. That means the client might just be struggling with paying it, doesn't want it any longer. So that's another one. But if you wait till that grace period, it does get more difficult, not impossible. We work through it all the time with people, but it requires a little bit of extra work and a little extra urgency to try to make sure there's a chance to salvage the policy.
Got it. So give us a spectrum of someone coming to you and asking you to assess, hey, am I able to sell this? And you would say, well, that's too small. Or also share with us, what's the sweet spot?
Yeah.
So when you see this, you're like, hey, we can really do something for you here. So, but when is it too small, when it doesn't really make a lot of sense? Yeah. And when is it just really in the pocket and you can hit a home run for your client?
Yeah. Too small death benefit wise is usually under $100,000, because there's certain fixed costs that these investors have to take on with every policy. So it just doesn't make any economic sense for them. So $100,000 is kind of the limit. Even a lot of funds don't even participate that low, but we can get it done depending on the situation. The ideal situation, usually, when I see somebody in their late 70s or 80s or so, not even 90s, once you're in your 90s, a couple things happen. One, the premiums get really expensive as you get older. So if they're still alive in their 90s, they get real expensive. So you think like, oh, that's prime. Not necessarily. We can. It works. But I'm just saying it's not as easy. It's like 70s to 80s. And usually people aren't, and again, I don't want to mislead people. You don't have to be, terminally ill or extremely unhealthy for this to work. Life expectancy, candidly, can be up to 15 years, maybe up to 20 years sometimes. And there's even a niche in our industry where they're buying unhealthy individuals, niche for certain types of policies, okay? But that being said, 70s or 80s with some health conditions, but it's like, you still, expect life expectancy to be, we have another 10, 15 years at least, with mom or dad or grandma or grandpa, whoever it is, right, that we have left. And we're not sure that we need this coverage anymore, or the premiums went up, and we're just not sure we want to pay it any longer. Those are situations where the age is right at the right level to where we could probably generate some good life settlement value. Now, what is good, though? It depends on the family, right? I mean, it depends on what your needs is. If you want the policy, there's a lot of reasons still to keep the policy. But, a lot of times, when those premiums start increasing significantly in their late 70s, early 80s, and keep in mind, by the time it's in your late 70s or 80s, those term options where the premiums are really cheap, those are gone by then. There's very rarely, every now and then there's a unique policy, but there's no cheap life insurance at late 70s and 80s. Yeah. No matter what, it's going to change. Something's going to change, and it's going to get expensive. Yeah. No matter what. Okay. Now, if you have enough cash value in the policy that's paying the premiums and you don't care and it's invested, well, great, keep the policy, whatever. But it's going to change. And we see it a lot. We've seen a family had a $5 million policy, and then all of a sudden, the mom in the family's in her early 80s, and all of a sudden it jumped to like $200,000 a year. Wow. You're like, $5 million policy. It's still $5 million, but it's $200,000 a year right now, and they don't expect mom to pass away soon, So, they actually were able to sell the policy for like $1.5 million. So, they got out of the policy, they took the cash, and mom lived for years to come. So it just depends, every situation's unique and different. Yeah. But in general, if you're in your late 70s, early 80s, or just 80s in general, those are prime times when it's really probably going to work, or at least I should say we're going to get value. Now, whether or not it works to the family's liking or what they want to achieve, that's a different question. So it depends on motivation and what they're trying to accomplish.
Got it. So in the financial advisor space, what is your experience with financial advisors, knowing someone like you exists, knowing this industry exists?
Yeah, it's still very surprisingly, a lot of them know about it now, or they've heard of it. A lot of them have never conducted one on behalf of their client, though, and so they know very little about it. There's still a lot of awareness to create to make sure that, they just think about it as just one more option. It doesn't always make it the right option, right? But it's just one more option to consider if your client needs funds, tired of paying premiums. One other thing for like large policies, and probably in anticipation of the estate tax exemption staying high, I think it's around $14 million per individual right now. So for like a wealthy couple, it's almost $30 million. But they get life insurance, and they place it into an irrevocable life insurance trust sometimes, so that can provide protection to pay taxes if they have a large estate. Well, assuming that stays high, like for instance, in this next year or two, there's a chance that a lot of people are overinsured. They have too much life insurance, and maybe they want to sell some life insurance. They don't need as much life insurance as they thought they might. And that happened, actually. I'll give one more example. Wealthy family had $4 or $5 million policies, and they decided, we don't know if we need these two. They kept two and sold two.
They had $4-5 million policies.
$4 or $5 million policies.
Wow.
Yeah, very high net worth family.
Yeah.
But for coverage, et cetera, and they decided, we're not sure we need these two. They kept two and they sold two. So It just depends on the situation, but that's sometimes what I'm saying is it's not just if people need cash. That family really didn't need the cash, but they didn't need the coverage and they didn't want to keep incurring the life insurance expense. So that made sense for them.
Got it. And who are the primary referral partners you work with? Who's sending you business?
Yeah, oftentimes like general agencies and life insurance agents themselves. So when I say general agencies, the ones with the high level life insurance company relationships, and then they have a bunch of agents that work for them. But it can be estate planners, CPAs, business advisors, actually a lot of health benefit brokers, and even people working in in health insurance with Medicare or with people that work with reverse mortgage. They're in the demographic, so and they're working with people that are older, may have some financial needs. So those kind of people also refer business a decent amount, as long as they're aware of the option. But a lot of times it's anybody in some type of advisory capacity, just general financial advisors, wealth planners, that is taking a look at a client situation and overlooking and just looking, does this life insurance policy make sense for them anymore? And then even sometimes, assuming the client's health is still relatively good, they might be able to get out of an existing policy, sell it, get some cash, and apply it to a new policy that's more appropriate. So you take the cash, you sell it, and you put it into the new one, or you just take the cash and get a new one. So that happens sometimes as well.
If someone's watching this right now, let's say they're in their 50s and 60s, they have that key man policy, they're looking to exit their business, where should they turn? Who do they go to assess and review their policy, to tell them, step one, this is what your policy is, these are the trigger dates?
Yeah.
Because in our scenario that we had recently where my client was looking to exit these policies, they had never consulted with their advisor. And I can tell you that this probably happens a lot. You can confirm or deny this, but a lot of the insurance salespeople seem to be in and out or all over the place. And so the person that sold a person a policy isn't necessarily there anymore.
Yeah.
So where do they go if they listen to this, they watch this, and they say, oh, wow, that's me.
Yeah.
I don't know what I have. I don't know if there's an appetite for my policy. Where should I turn to learn what type of policy I have in the beginning? I'm not looking to transact with you yet, but where should I turn?
Right. Yeah. I would say first and foremost would be if you have a wealth planner, financial advisor, or the life insurance agent himself. As long as you still have a relationship with them and they're active helping you, turn to those kind of people that you already have a circle in. And we're working with those people. We are the resource most of the time for advisors, right? We do work direct with clients when they come to us. That being said, if you don't, they could just come directly to us, for instance, and we can do an evaluation, whether it's appropriate or not, or even if it's not a life settlement candidate, we could at least look at the policy, give you a few ideas, maybe identify that conversion expiration period for you if that's if it's a term policy, and determine. But if you don't have anybody, oftentimes that is what happens. A lot of them feel abandoned, or they don't have an advisor, they don't have anything else, and so they need somebody. So that's something that we offer as well, just to glance at it, see if it makes sense, and see if a life settlement could be an option for them.
Got it. So when you're in the process, I'm certain, maybe I'm wrong, but people tell you what they're going to use the money for. Now, a lot of it is probably we're going to use the money to live. Maybe we need the money. Maybe they're going to give it to their children. Or what are some cool things people have said? Hey, I'm going to sell this policy and maybe buy a boat or something like that. Has that ever happened?
There are some people who are upbeat and they're like, we're selling it. I'm taking my wife to dinner. We got, you get, or whatever, or I'm going to pay off my mortgage. It happened sometime. That happened, I'm going to pay my mortgage off.
That's good.
That's cool. Some people have just fun with it. One thing that comes to mind recently, we helped somebody, and this gives another example. If people do have like cancer, a terminal illness, a life settlement could be an option for them too. Now that's a tougher situation, and it doesn't always, again, there's a reason to keep the policy too, right? But everybody's situation is different depending on what they want, and we recently worked with a couple who had a few policies, and they both had cancer. It was tough. Not like they were like passing in the next year or anything, but they both had cancer that was pretty serious, and they didn't have no children, and they didn't want to keep the policies any longer, and they received $500,000 for their $1 million or so in coverage. and they wanted to take a big trip to Africa together.
Wow.
They wanted to go to Africa. They wanted to go big safari in Africa before the time comes, you know? And God bless them. I mean, that's awesome, right? I mean, you know, they get to do that. So, you know, you hear everything, and there's no, you know, perfect. Everybody's life is different. You hear a lot of situations. Sometimes it's hard. I mean, it's not easy. It's, you know, it gets tough, you know, and you want to, it's a sensitive subject, and you want to make sure you're, you know, we're very sensitive to that. You know, we take a very educational approach, you know, at our company. You know, it's very much gather the information, present the facts, help the advisor determine, does it really make sense? Does it make sense? You know, and a lot of times we can go down that road and we could do the work and they still don't want to sell, and that's okay. That's just, you know, at least we got something, you got some idea of what the value is, what it might be, and maybe in the future it makes sense for you, then it doesn't make sense now. But it's, you know, it just depends, you know, but it's great when it turns out and you can really help people accomplish some real life things they want to do in their life, some life goals, or just whatever it might be. You know, it works out really well sometimes. Yeah.
Got it.
Yeah.
Do you run into advisors who have a bad view of your industry and say, oh, I would never refer that. I don't trust this process. I don't trust this industry.
Yeah.
You run into anybody that says that?
Yeah, definitely. I mean, sometimes, not as much anymore. We used to more. I mean, I've been in the industry a long time now. Used to more. Part of the reason was the insurance carriers frowned on the industry a lot early on, although they've come to accept it now. But now that the regulation has kind of turned the corner and it's accepted, and again, I always say, you know, why is it going to be around? Why will life settlements, why consider them, you know? From a fiduciary standpoint, how can't you if it might be the best option? Mm-hmm. How can't you? Like, if you really want to do what's best for your client, how can't you consider it, right? Just like the example I gave earlier of, you know, the policy, and, you know, they had whatever it was, $50,000 or so in the policy, and they ended up getting $425,000. Are you going to tell your client just to take the $50,000 and let's not look into a life settlement? That would be, you know, you have to look at it. And to take it a step further, actually here in California, there was a couple that sued their advisor and a life insurance company because they didn't tell them about life settlements and they let the policy lapse.
Oh, wow. Is there a rule now where they have to tell them?
There is. Some states are rolling out regulation where it has to be informed as one of the options.
Oh,
yes.
wow.
Yes.
Okay.
So I don't know that they're going to completely regulate that and make it mandatory, but I'm just saying, again, you know, since life insurance is a piece of property that can be sold, and it might have a lot more value than the cash value or no cash value, why wouldn't you have it on the table? Let the client make the decision if they, you know, want to do it or not, but it should be on the table at least as an option. And a lot of times, you know, the average by the U.S. Accountability Office is like, when people sell their policies, on average, they receive 7 times more than the cash surrender value from the life insurance policy on average. 7 times more on average.
Really?
A lot of times it's way more than that because the cash value is almost zero, and it's like almost infinite a lot of times. So if we can't exceed the cash value, and then it doesn't make sense, and you don't want the policy, take the cash value. But a lot of times we're going to be able to beat that cash value.
Got it.
Yeah.
So this is fascinating. Before I reconnected with you, I had no idea this industry existed.
You're not alone, yeah.
What I'm going to do is I'm going to take all the policies that I have to an advisor and say, what do I have? Just my memory is saying that I have a good whole life policy. Mm-hmm. It's one of those where when it's paid up when I'm around 65, it just continues to go on for the rest of my life.
Yeah.
And then the term life policies, I remember the advisor saying that these will be convertible at some point.
Yeah.
So I'm definitely going to get my policies reviewed and assessed so that at least I understand the trigger points.
Yeah.
Just in case I want to move forward with having someone like you sell my life insurance policies in the future.
Yeah.
So
you're way too young to do it now, and I don't want you to have to do it. So you know,
that's right.
So no worries there right now. But yes, knowing that is important. And like I said, you know, we don't know when some serious health issue is going to pop up. So know at least for that too. You know? For, you know, life settlement part, fine, but know it for your own life, for knowing, you know, what if something happens? What if I want to be able to keep this coverage if something happens? I want to be able to convert it. Know those dates. It doesn't take much to identify what the dates are. Mm-hmm. And then maybe the answer is when that comes up, you just get another term policy when you're older. At 65, you still could probably get a 5 or 10 year term policy.
Got it.
So what I'm saying is maybe just do that, you know, or maybe you don't convert it. But At least knowing the dates is very important.
Got it.
Yeah.
So I told you I was going to ask you this yesterday.
Yeah.
And you do not help people. I want everyone to realize.
Yeah.
You do not help people originate life insurance policies. You do not help them get life insurance policies.
Correct. I'm not helping with new life insurance policies.
Yes. Right. So I think you're the perfect person to ask this question.
Right.
When I was first approached to buy whole life, I had an individual mentor when I was younger say, Ryan, you're married now, get a term life policy, right?
Yep.
That was it. And then later on in life, I met an individual who sold whole life insurance. And he shared it with me. And as a banker at that time, I thought, you know what, this is a really good way to build cash value. And then he introduced me to the infinity banking model. And I understood it to a certain extent, but I still don't necessarily fully understand it. But I do get it. Hey, you know what? Like, let's say today I have $50,000 in cash value and I want to buy a new car. Instead of going to a lender, guess what? I can tap into my cash value, right?
Right. Sure.
And I have a 5% repayment interest rate. At right now, that's really good, right? That's low.
Yeah.
So I understand that, right? But can you settle the debate on whether a whole life policy is a good idea as an investment vehicle, or define it how you define it so that we can get an unbiased opinion from someone in the industry who doesn't originate but helps people exit their life insurance policies? When I was in the process of buying that whole life insurance policy, I went to the internet, like I think a lot of people do. And when you type in Google, is a whole life insurance policy a good idea? You're going to get pages of people hammering whole life insurance policy, saying absolutely not, put it in the market, it's way better.
Yeah.
So
I think Dave Ramsey's like anti-whole life, isn't he?
I think he's anti a lot of things, but I think he's anti whole life as well.
Yeah.
So Phil, you're an expert in the industry. You're not trying to get people to buy life insurance. Tell us your opinion on whether whole life is a good vehicle or not.
Okay, I cannot settle the debate. Just kidding.
There you go. That was a big ask. I get that. That was a big ask.
No, the truth is, in my experience, it just depends on what you want to accomplish and knowing what knowing the product that you're in and what you're trying to do. That's my take on it. Yes, the easy thing for protection when you're younger and have a family, et cetera, is just term life, cover your family, get something cheap, and invest your money elsewhere. Stock market, on average, it's 10% or so, put your money in that. And you'll hear people say that a lot. I think that's the kind of Dave Ramsey type equation. However, from what I know about whole life and looking at it, it can still be very, very beneficial type safe investment. Now, let's go the different types of whole life. Whole life, universal life, variable universal life, index universal life. Those are all types of whole life products, okay? So when I say whole life, traditional whole life, that's back where the premiums are rigid. They're kind of steady premiums. You pay into it. You build the cash value like you do. You get some dividends oftentimes from the insurance company, and you build a nice cash pile that you can borrow from in the future tax-free. That's where they say, hey, build it up. And then if you build it up according to this schedule and you stay consistent, you're going to have a nice big pot of cash to pull from as in form of a policy loan against the policy, tax-free, and that could help you live off that in the future. It's true. It's good. Now, if you compare it perfectly, the return to what you might have got in the market, maybe you're not as excited about it. Then you got to take tax ramifications, taking withdrawals. There's so many moving things. But it's a relatively safe, long-term, traditional whole life, relatively safe, long-term investment. Then you got universal life, and index universal life, and variable universal life, okay? So they're all universal life. As soon as you hear that term universal life, it's also flexible life insurance. The word flexible is in there, flexible universal life policy. That means there's some advantages. It's flexible because if you have a nice cash value and for whatever reason you're in a cash pinch sometime, well, that policy can pull from the cash value to make a premium payment. It can make the payment for you. That cost of insurance I was talking about earlier, it'll make the payment for you. So that's a nice advantage. what is the rate that money's appreciating at? Sometimes there's a floor, there's a ceiling. Index universal life means it's tied to the some market, an index, S&P, et cetera, but it's not invested in the market. Variable universal life insurance agents have to have their securities license to sell that. It's actually invested in the market. You're putting money invested in the market with a life insurance policy. That's different, okay? These all have more risk, though, because that cost of insurance is going to go up every year. It's going to increase. And then all of a sudden, these are the ones where people find themselves in trouble more than not. Right? Traditional whole life, they do as well, but these universal life index, a lot of people sell it. And don't get me wrong, I'm not saying they can't be great products if they're modeled right. It's just, again, and it's not that, it depends on, yes, it can be oversold sometime, no doubt about it. The commissions are sizable on these. They can be oversold. There's not a question, but that's any industry. It can be oversold. It's just knowing what you're in. You should at least have an annual review with the guy who got you into it, or review it annually and just say, wait a second, what's this doing? Wait, where's the cash at? Wait, is it performing like it's supposed to? Because like these universal life products, they also, the rate of return in them, whether it's index, variable, et cetera, they also fluctuate. So you might not get as much, and you might get as much. And all of a sudden you might find yourself, oh man, this isn't outpacing the cost right now. So it's just higher risk. And it's just almost like, you want to invest in stocks. What kind of stocks you want to invest in? You want to invest in blue chip, or you want to invest in high growth and take some risk? I mean, it's just knowing what you're in, right? So I would say traditional whole life, you're relatively secure if you have a plan and you want to put some money away long term. It's a good product. I'm not going to badmouth it. It's a good product. It's a good, safe product. The other ones, they can be good too. They just have more risk with them.
Got it.
If you want to be really simple, get a term, cover your family, and don't think about it and put your money elsewhere.
Got it. And do you find that more wealthy people are delving into these more exotic life insurance policies?
Yeah, they're being sold sometimes to them and things. But I've seen them, come up sometimes when people have definitely come back with certain policies, a universal life or index universal life, and say, I don't know what I got into. I'm in this, or I put some finance, sometimes they put premium finance on it. And that's not a bad thing. I mean, you're using leverage and you get a big life insurance policy and it's not out of your pocket and it's and has a rate of return that's going to outpace it. It's not all bad, but yeah, people, depending on how they're structured, they end up underwater sometimes, and then they got to post collateral. So it's all the above. It's just more of a involved transaction, But with the right advisor guiding you, et cetera, I think it all can be good. It's just depends on it. It depends on how involved of a transaction you want to be involved in, I guess.
Yeah.
Where are you as the buyer to say, yeah, I'm willing to roll the dice on this and see, and hopefully it performs and I'll do well.
So anybody who is buying a policy other than a basic term life to protect their family should know exactly what they're doing and why they're doing it.
Just ask a lot of questions.
Just ask a lot of questions.
What's the worst case scenario? What happens if this? Yeah. What happens if we have a few bad years on the return in this? What if I have a loan? Is this going to outpace? Do I got to post collateral? Just ask a lot of questions. Yeah. I mean, just know what you're getting into, and maybe those questions will scare you out of it and be like, the heck with it. I'm just staying with Herm,
There you go.
Maybe that's the right answer for you. But just ask a lot of questions. Yeah. I mean, that's my recommendation.
Phil, this has been fascinating. Thank you so much for taking us into your world and your industry. Really appreciate it. Ryan. I think this is going to be valuable for a lot of people, especially business owners who have those policies, who watch this. So thanks again. Have a great day, and we'll see you soon.
Thanks, Ryan. All right, brother. Thanks.